Welcome to The Explainer. Today, we're diving straight into a massive shakeup, newcomers versus old-timers in the world of finance.
Imagine a high-stakes collision happening right now in the Nigerian financial sector. On one side, you've got these incredibly agile, fast-moving fintech newcomers. And on the other, the traditional banking old-timers rooted in decades of established practices. To guide us through this clash of business models, we're relying on the brilliant insights of analyst Oluyomi Oladevid. As she so perfectly puts it, whoever says newcomers are not welcome is certainly a cruel old-timer. Throughout her analysis, she breaks down the nuts and bolts of this financial evolution, looking really closely at both the human and economic impact of this whole rivalry.
Now, before this disruption hit, traditional banks were basically fast asleep on their status quo couches. Oladevid actually uses this incredibly vivid metaphor to describe an era where growth in the Nigerian financial sector was, well, frankly, pretty abysmal. The informal sector was everywhere, and the old-timers were just deeply complacent. But then, enter the fintechs. She describes this wave of new entrants as a refreshing breeze. I mean, they aren't just participating in the market, they are forcefully shaking those old-timers awake from their slumber. So what's really fascinating here is the fundamental structural difference between the two models. Think about it. The old-timers are carrying this massive overhead from vast physical branch networks. We're talking rent, utilities, on-site staff, the whole shebang. Fintechs, on the other hand, they leverage modern tech to provide completely bespoke financial services. Their teams can work entirely remotely, and they have literally zero physical branches. This gives the newcomers an absolutely massive cost advantage right out of the gate. And because they have that incredible cost advantage, fintechs can play a completely different game. Honestly, her take on this completely shifted my perspective. Their goal, number one, it's actually not immediate profit. Oladevid observes that if you think a new business has to drive primarily for instant revenue, you just don't understand these newcomers. They are totally willing to sacrifice short-term financial gains just to achieve a clientele benchmark. Basically, they want to aggressively woo clients and snatch up massive market share from the traditional banks by playing the long game of user acquisition. So, how exactly are they pulling this off? Well, they're throwing everything at the wall to secure new accounts. And honestly, it's working. They're offering cash bonuses just for making savings deposits. They're handing out low or even zero-fee bank-to-bank transfers, which, by the way, is something traditional banks rely heavily on for their revenue. They're rolling out flexible investment options and handing out bonuses for clients gained through network marketing. You've probably seen these exact types of aggressive offers popping up on your own phone. These are super expensive perks that traditional bank models simply cannot afford to match. But let's just pause and slow down for a second. We really have to ask a fundamental question here. Do saving deposit bonuses and network marketing perks actually help the deeply impoverished and excluded market segments? In an economy with a high incidence of poverty, we need to consider, are these newcomers genuinely solving the real problem, or are they kind of just fighting over the exact same privileged customers?
And this brings us to a crucial distinction in her analysis. Securing a new account with a flashy sign-up bonus, that is not the same thing as actually growing demand in the wider economy. Oladevid points out that to truly operate in economies with high poverty rates, fintechs cannot just rely on slick tech and marketing. They have to figure out how to reach the poor in excluded segments with tailor-made financial services. I mean, handing out a zero-fee transfer doesn't really help someone who doesn't have money to transfer in the first place, right?
That blind spot leads to another major vulnerability for the newcomers. She offers this fantastic warning, and I quote, "Like the energy of youth that tends to run wild, some fintechs may want to run wild against regulatory frameworks to their own detriment. That youthful energy, rapidly accelerating and rushing forward, is exactly what makes them so innovative. But it is also incredibly dangerous. Because when you move fast and break things in the financial sector, well, the things you break are often critical, highly sensitive economic regulations. The consequences of running wild are very real. Actually, we've recently seen reports of heavy sanctions dropping on fintechs by Nigeria's Apex Bank. And this is where the entire narrative kind of flipped for me. Suddenly, those old-timers who were asleep on their couches, they look a little different. She notes that whoever says the experience older folks have garnered is useless simply hasn't been properly groomed. These old-timers deeply understand the regulatory landscape. They know exactly how to navigate the Apex Bank. Their traditional experience in the market isn't a burden anymore. It's absolutely vital for survival.
So we've set this whole scenario up as a clash, but the reality is actually much more nuanced. As brilliant as these agile fintechs might be, their long-term resilience really depends on their willingness to learn. Ola David argues that their ultimate survival relies on cooperation and partnerships with older banks, rather than just trying to destroy them through fierce competition. The truth is, the newcomers need the old-timers just as much as the old-timers need the newcomers.
Based on her analysis, here is the practical roadmap to building that win-win partnership. Step 1. You take that bespoke fintech innovation and combine it with the invaluable benefit of hindsight that the older banks possess from working in the Nigerian market. Step 2. You create direct learning linkages between the two cultures. Step 3. This fosters knowledge spillovers where tech agility informs regulatory compliance and vice versa. And finally, step 4. This combined ecosystem achieves true, sustainable growth. It's like the perfect marriage of agility and experience. This leaves us with some final provocative thoughts from her source material. As we watch this financial landscape evolve, how exactly are these fintech firms going to achieve true economic efficiency by minimizing the cost of exchange? How will they drive sustainable growth and authentic financial inclusion for the absolute poorest segments? And ultimately, how might these win-win partnerships, rather than purely competitive strategies, raise overall productivity in the banking and financial services sector? It's a completely new way to look at market disruption. Think about that the next time you open your banking app. I'll see you in the next explainer.